commodities always have periods of 3, 4, 5 years of just nothing. And then they blow up and we get chaos for a couple of years. So they go in cycles of both price and volatility.
Mm-hmm.
So yes, things will calm down. But the unfortunate thing is commodity prices almost always go down, or at least they trade sideways or go down. They go down more than they go up. That's a reality that we all have to accept.
This episode is proudly brought to you by Mapper Forward's workshop. It's time to become a coffee consultant. Learn how to diversify your revenue streams and create freedom from your day job while saying goodbye to that alarm clock forever by becoming a consultant within the coffee industry or directly to consumers who have shifted towards home brewing and home roasting. Protect your income from challenging times in the coffee value chain by taking this course today. Go to mapperforward.coffee/workshops or click the link in the show notes for details. Welcome to the Daily Coffee Pro by Map It Forward, friends. I'm your host, Lee Safar, and this is episode 2 of a 5-part series with Carley Garner from DeCarley Trading. And if you are looking to figure out how to hedge, no matter where you are in the supply chain, hedging could be an option for you. And I would encourage that if you are thinking of doing that, please do not do it on your own. Please go and get a professional to help you do that, because Caleb Holstein was on the podcast talking about how it's a whole other arm of your business. Is that right, Carley?
It is. It's basically a lot of commodity producers have basically hedging desks or operations. So yeah, and of course we do. We also work with mom and pops that do it on their own. But what I think you bring up a great point. I will just add one thing,
please.
I think people think it's easier than it is. And I think people don't, they underestimate the emotional turmoil that it might cause. For example, in a market like coffee, where you could see on a single futures contract, you can see $20,000, $30,000 moves relatively quickly. So if you're aggressively hedging and you're trying to lock in your prices and you sell a futures contract to lock in your harvest price, and the market continues to go higher, $30,000, $40,000 without you, people panic, people don't know how to meet their margin calls. And so it gets really hectic. So there's ways to hedge without doing it in such an aggressive way that's going to trigger your emotions. Because in the end, these markets it's a mental game. Even if you're a producer, I know people don't think of it that way. They think of it, it's the grind of planting, pulling it out of the ground, but it's really a mental game. Because once you get it out of the ground, you have to sell it, and you have to sell it at a price that you can make money. And if you're not putting yourself in a mental stability situation, you're going to make bad decisions, and it's really hard to recover from that.
And all of that is it adds to the volatility of what's going on right now. And in this episode, we're going to talk about volatility. Before we do, folks, just a quick note. If you want to support this podcast, can I encourage you to do one of 3 things? Share the podcast with your colleagues in the industry. Number 2 is on YouTube, you can join our paid membership. And number 3 is that you can join us on Patreon. So we would love to have your support. And the reason we want your support is because we think that this kind of content is really important for the evolution of our industry. And we don't want sponsors who are going to impact and try and influence the content that we have. There are people that are trying to do that. So we have had to remove any kind of sponsorship from the podcast because people have tried to ask us if they can buy the podcast so that they can stop the podcast from happening, etc., etc. Anyway, that's how you can help keep everything going. Now, we're going to be talking about market volatility. Where does market volatility come from in a commodity market like coffee, Carley?
Okay, so we just talked about human emotions. The reality is the price of coffee or cocoa or even stocks or whatever it is, it only moves because humans are buying or selling. And so it moves faster when humans are more motivated. Maybe they're panicking, maybe they have fear of missing out, whatever the cause is. Humans themselves and our emotional selves are what cause the volatility. There's also some additional factors. So if you're familiar with the way markets work, there's 2 different types of orders. you can, well, there's more than two. But let me just leave it at
simplify
this. So when you buy a futures contract, you're hoping the price goes up. Mm-hmm. But a lot of people will put a stop loss order just in case they're wrong to prevent them from losing more than what they would like to risk on the trade. And for whatever reason, humans tend to put their stop losses at roughly the same time. So as an example, if you think coffee is going up and you buy it at 235, but you're only willing to risk 5 cents, you put your stop at 230. Maybe 100 other people did the exact same thing and they have their stop at 230. And if that's the case, if the market trickles down there and hits those stop orders, which all happen to be in the same place, and again, for some reason, we all kind of think the same, we're wired the same, we tend to put the stops in the exact same place. And then suddenly the market drops 10 cents just because those orders all need to be filled. And now people are wondering what's happening, what happened, what's the story, and then everyone hits the sell button. So again, humans, we cause volatility. We do it all the time. We panic.
What role does supply and demand play in that volatility? Because I would assume that given that this is, and a lot of people say that, it's a commodity. Like, shouldn't supply and demand economics be what determines the volatility in a market? And it seems like that people look at me and say, stop being so naive.
In the long run, the math has to work. In the long run, supply demand is all going to come into line. In the short run, no. You can see some really big, chaotic gyrations that have nothing to do with fundamentals. They're just people need to get out, people need to get in. Somebody's, has to get out because they're losing their house. I mean, who knows? It could be anything. But those sorts of things are noise. But in the big picture, supply demand obviously matters. And that's what drives the bigger trend. The most difficult part about commodities is if you're speculating, it's hard. Even if you're right on the big trend, it's hard to actually be in the market at that time because of all the gyrations that are intended to force you out. And as a hedger or a producer, it's the same thing. It's really stressful to watch the price of coffee go up or down 10, 20 cents because that changes your operation completely. So, unfortunately, volatility is here to stay. I know there's people that say, well, why don't we just peg the price? The reality is you just can't do that. If you peg the price, everybody wants to be a producer because you can't lose money. So then suddenly we have a flooded market. I mean, it sounds like a good idea, but in practice, it just doesn't work. It's kind of like there's been a few, like the Chinese tried to do it with their currency and it basically just interferes with everything around it and creates more chaos. So you're trying to solve one problem, you end up causing chaos everywhere else.
So coffee producers say to me all the time, why do we have to have speculators? It seems like they're causing a lot of this problem. They're causing a lot of the volatility. And if it was just up to producers, they would peg the price because then they would be able to just add differentials onto that would give them some kind of predictability. Yeah. So what role are speculators playing in this volatility?
Right. So again, it sounds like a good idea to let's pull all the speculators out and just keep it as is. Look at a market that has very few speculators like olive oil or lumber. You know what I mean? They're not doing any better. In fact, they're a lot more volatile than markets that have speculators. I will say, like as a commodity broker, obviously I'm biased, so because I'm on the other end of it. But speculators bring liquidity. If you take all the liquidity out of the market, then you're removing people's ability to hedge, to lock in their price. And again, peg prices really, they sound good on paper. They just don't work in reality. It's just not, because you end up, both sides of the transaction have to be happy. And that was just a whole different podcast, so I'm not even going to go there.
Hold on. I want to explain. I want to understand that. I think what you've said is really, really important because I don't understand it, and you've said it on the podcast twice before, and I think I don't know what I'm missing. If I understand it correctly, the liquidity in the market means that speculators are on the other side of people selling contracts. And because of that, they're putting cash into the market so that someone selling a contract has someone buying that contract. Is that what you mean by that?
Yeah. Liquidity is the ease at which you can buy or sell. So if let's just imagine there's no speculators. And if you see coffee at 235 and you say, wow, that's a really great price in the futures market, I think I'm going to sell a futures. so that I can lock in my price. And what if there's nobody to take the other side? And that quite honestly could be something that would happen, or at least they won't take it at 235. They'll give you a haircut and take it at 220. So the bid ask is 20 cents instead of a tick. Speculators, I will admit, speculators push things further than where they would normally go. So, but this can work in your favor or against you. So as a producer, let's just take corn, for example, because we had a really big blow up in corn in 2022. Mm-hmm. Corn went from, in the span of a couple of years, corn basically went from $3 to $8.
What?
And yeah. And now it's back down at $3.80. I think it was $3.80 on Friday. So it gave it all back. And I've been working with farmers all of this time, really encouraging them to hedge. Sadly, a lot of them did not hedge. Sadly, a lot of them watched corn go all the way up to $8 and all the way back down to $3 and didn't do anything about it. But the interesting thing that I found in talking to people is nobody was complaining about speculators when it was $8 because corn had no business being $8. Yeah. We should have been at $5.56. That would have been the fundamentally sound price, but we got to $8. And the fact that they didn't do anything about it isn't really this, unfortunately, that's the decision they made, and now they have to live with it. But now everybody's complaining about speculators because fair price is probably, honestly, it's probably around where we are, but we probably go another 50, 60 cents lower. And yes, probably because of speculators. But nobody cared when it was working for them, and now they care when it's working against them. So it goes both ways. We can't change it or fix it, like snap our fingers and fix that sort of thing. But what you can do is you can control how you behave and how you react to those types of overshooting prices.
It's all very confusing to a lot of people because in the coffee industry, the low barrier to entry means that we don't have to learn any of this stuff. And people only learn it when they have to learn it. And now we're at a part in our industry where people are like, what? The price is at $2.50. It's way higher than it's ever been. Who's buying the coffee? Why is the coffee so high? Some people are saying it's going to go super, super high. Other people are saying it's going to drop. What's actually going on in the cash market? Why aren't they the same thing? There's just a lot of confusion, and this is what's driving the volatility. Do we ever see a time where this is going to be a little calmer consistently?
Well, I mean, commodities always have periods of 3, 4, 5 years of just nothing, and then they blow up and we get chaos for a couple of years. So they go in cycles of both price and volatility. So yes, things will calm down, but the unfortunate thing is commodity prices almost always go down, or at least they trade sideways or go down. They go down more than they go up. That's a reality that we all have to accept. And when they go, as they're going down, it's usually like a slow dribble, and it's usually pretty painful, and everyone's waiting for something to happen, and it never does. But the reason that commodities do that, and earlier in the first segment I mentioned the all-time high in coffee is like 337, somewhere in that ballpark. That occurred in the 70s. So just imagine, we've never seen that price again, ever. And everybody talks about inflation and the dollar
Not
and
in
the currency.
coffee.
Yeah, global. But coffee's literally traded sideways, with 175 being basically the middle of the pack. And that's probably the reality forever. And you can, there's lots of reasons why, but one reason is technology. As time goes on, farmers get smarter, they get better. The science gets better, the machinery gets better, technology gets better. And so again, we've seen this in the US with corn and soybeans and wheat. The farmers are too good. They're too good at what they do. And when prices get high, they start, they get rid of their parking lots and plant part of their crop in the parking lot. And then the next thing you know, $8 corn is $3 corn. So unfortunately, because farmers are so efficient and they get better and better every year, it puts downward pressure on agricultural commodities overall.
Before we wrap up, there is one thing that I think we still need to explore in this episode, and that is a little bit more about the speculator with regards to that.
Okay.
Who is a speculator?
It can be anyone from just someone like you or me that has $5,000 that they want to, I don't want to use the word gamble, but it's gambling a little bit if that's what you're doing. So it could be something as simple as that, or it could be There are large funds that basically pool people's money, and a lot of the funds, what they do is trend trading. So if coffee prices are going up, they just keep buying, and they have enough money to support drawbacks, and they're working with deep pockets that can withstand the ebbs and flows. Whereas a retail speculator couldn't. A retail speculator buys coffee with a $5,000 account, blows it out, and then coffee goes up without them. That's unfortunately what happens. We try to discourage people from doing that sort of thing, but humans do it. So it could be anything in between those two big extremes. It's not people. I will also say this: people assume that all speculators make money. Not the case. In fact, most speculators are losing money. So while we're bad-mouthing speculators, we should probably understand that the hedgers are coming out way ahead, while the speculators are just basically donating to the system.
You set us up for the next episode perfectly, right, where we're going to talk about hedging. So join us for the next episode, folks, where we're going to deep dive into hedging. Brace yourselves. Peace, love, and peanut butter. Have an amazing rest of your day. I really hope you enjoyed this episode, friends. Please don't forget to show us some love by subscribing, liking, commenting, and most of all, sharing this podcast with your friends. Check the show notes for links, including our sponsors and our Patreon. And stay tuned for more great conversations on the Daily Coffee Pro by Map It Forward.